What if the most powerful system shaping your daily life has no headquarters, no army, and no visible authority, yet influences nearly every decision you make? Think about how many times today you used money. You paid for food, transportation, entertainment, or bills. But here is the real question. When you used money, were you simply spending it, or were you interacting with a system that observes and records your behavior? In 2026, the global economy is undergoing one of the largest transformations in financial history. Digital payments now dominate transactions in many countries, and more than 130 central banks worldwide are researching or developing central bank digital currencies, often called CBDCs. Governments and financial institutions present this shift as a natural evolution toward faster payments, lower transaction costs, and broader financial inclusion. And in many ways, they are correct. Digital transactions are efficient. They reduce fraud, simplify global trade, and make economic activity easier to manage. Carrying physical cash is becoming less common, especially in major cities where mobile payments and online banking have become standard. Convenience has never been greater. But convenience always raises an important question. What changes when money becomes fully digital? Unlike physical cash, digital transactions generate data. Each payment records information such as time, location, amount, and category of purchase. Financial institutions use this information to improve services, prevent crime, and assess risk. This data-driven system increases efficiency, but it also transforms money from a simple exchange tool into a source of behavioral information. This is not a conspiracy. It is simply how modern technology works. When you use digital money, the system learns your habits. It observes spending patterns, income cycles, and financial behavior. Over time, these patterns create a detailed financial profile that influences credit access, financial opportunities, and personalized services. So the real transformation is not just digital payments. The real transformation is the data economy surrounding money. And this raises a deeper question. If financial systems increasingly understand your behavior, predict your needs, and respond automatically, how much of modern economic life is shaped by your decisions and how much is shaped by the system itself? Next, we'll explore how financial data does more than record your choices, it actively shapes them. How money shapes behavior. Have you ever noticed how online stores seem to know exactly what you want before you even search for it? That experience is not accidental. It reflects one of the most powerful features of the modern financial system, behavioral prediction. Today, companies analyze massive amounts of transaction data to understand consumer habits. They study when people spend, what they buy after receiving income, how they react to price changes, and which products they consider but do not purchase. Even incomplete transactions provide valuable information. This process is part of what economists call behavioral economics, the study of how psychological factors influence financial decisions. Businesses use this knowledge to design environments that guide consumer behavior. Discounts appear at strategic moments, recommendations match personal preferences, and payment systems remove friction from purchasing decisions. The goal is not to force behavior, but to make certain choices easier than others. This system benefits consumers by offering personalized services and relevant products. It also benefits companies by increasing sales efficiency. But it also demonstrates how financial systems increasingly shape economic behavior rather than simply responding to it. By 2026, global spending on data-driven advertising exceeds hundreds of billions of dollars annually. The reason is simple. Predicting behavior is more profitable than guessing demand. But here is the interesting part. People often interpret these guided choices as purely personal decisions. The system influences behavior subtly through incentives and convenience, rather than through direct control. This raises an important philosophical question. If your environment constantly adapts to guide your decisions, where does personal choice end and system influence begin? Financial technology also increases this influence by tracking long-term behavior patterns. Spending habits affect credit scores, insurance rates, and loan eligibility. Financial history becomes a measure of reliability and trust. Money is no longer just something you use, it becomes part of how institutions evaluate you. And once financial behavior influences opportunity, the financial system gains a new kind of power, the power to shape participation itself. That leads to the next question. What happens when access to economic life depends on digital systems? Economic participation in a digital world. Throughout history, participating in economic life required simple tools: money, labor, and exchange. Today, participation increasingly depends on digital infrastructure. Modern economies rely on interconnected financial networks. Salaries are deposited electronically, bills are paid online, services require digital verification. Financial identity is linked to economic activity. This interconnected structure creates remarkable efficiency. Payments move instantly across borders. Businesses operate globally. Fraud detection systems protect consumers. Economic activity becomes faster and more secure. But interconnected systems also create dependence. If access to digital financial infrastructure is interrupted, participation becomes difficult. This is already visible in situations involving technical failures, account restrictions, or system outages. When digital systems stop working, economic activity temporarily stops as well. This does not mean financial systems are designed for control. It simply shows that centralization increases both efficiency and vulnerability. The modern economy functions because participants trust the system to remain accessible and reliable. Trust is the foundation of financial stability. However, as digital systems expand, they also increase the importance of governance, regulation, and accountability. Policymakers debate how to protect privacy, ensure fair access, and prevent misuse of financial data. These discussions are ongoing worldwide. The transition toward digital finance therefore creates both opportunity and responsibility. It offers innovation, but also requires safeguards. And this brings us to one of the most debated aspects of modern finance, the future of cash. Throughout centuries, physical money provided a simple form of exchange. Cash transactions required no infrastructure, created no automatic record, and allowed direct interaction between individuals. Today, cash usage is declining in many parts of the world. Digital payments are faster, safer to store, and easier to manage. Governments and central banks view digital currencies as tools to improve financial systems and reduce costs. Supporters argue that digital currencies could increase financial inclusion, reduce illegal activity, and improve monetary policy. Some proposed systems even include privacy protections and offline functionality. However, critics raise concerns about financial privacy. When transactions generate permanent records, individuals may lose some degree of anonymity in economic activity. Therefore, policymakers face the challenge of balancing efficiency with privacy rights. This debate reflects a broader question about technology and society. Every technological advancement changes the balance between convenience and autonomy. The internet improved communication but introduced new privacy concerns. Digital finance follows a similar pattern. The future of money will likely involve a hybrid system combining digital efficiency with privacy protections. Many central banks emphasize the importance of maintaining individual freedoms while modernizing financial infrastructure. The outcome of this transformation is still being shaped. Which leads to the final question: what kind of financial future are we building? The evolution of money reflects the evolution of society. From barter to coins, from paper currency to digital payments, financial systems have always adapted to technological progress. Today's transformation is unprecedented in scale. Digital finance connects billions of people, accelerates global trade, and enables economic participation on a massive level. At the same time, it introduces new challenges related to privacy, control, and governance. The future of money will depend on how societies balance efficiency with freedom, innovation with regulation, and convenience with personal autonomy.
Technology itself is neutral. Its impact depends on how it's designed and governed. The modern financial system is not simply a tool, it's an environment, one that shapes opportunities, influences decisions, and structures economic life. Understanding this system is essential for navigating the future. So the next time you make a payment, pause for a moment and consider what money represents. It is not just value, it is information, infrastructure, and influence. The real question is not whether financial systems will change, they always have. The real question is how much control individuals will retain in shaping that change. And perhaps the most important question of all is this: will convenience continue to define our choices, or will awareness guide the future of money?